If you see calendar year till date, Indian market like Nifty is the worst performing market with 3% correction, while Nasdaq is the best performing market with 16% gain. So we have seen that India's overvaluation, which was there in September to December period in 2022, that has resulted into a slight underperformance over last 3-month period. So what is our view on markets at current juncture? If you have seen the US Silicon Valley Bank crisis and European Credit Suisse Bank crisis, the central banks and governments have infused the liquidity and capital in these banks and supported all the depositors. So we believe that the current crisis of these banks will not have a Lehman Brothers crisis kind of situation, because this time the credit and capital adequacy of the banks is quite robust. That's why we feel that as governments and central banks are supporting these banks through infusion of liquidity, there will not be a contagion or spread of this crisis in across the world. Secondly, if you look at the concerns on US recession, we feel that the Federal Reserve is actually engineering a recession to get the demand down and hence commodity prices lower side. We believe that it will be a stagflation or a shallow 4 to 6 month kind of recession in the US, and it will not be a prolonged recession. At the same time, you have seen that OPEC has done a production cut, which has resulted into a short-term bounce back in crude oil prices. Interest rates and inflation are the bigger concern right now. So we feel that as the inflation is coming down, we will see in detail in next few slides. Interest rates are likely to peak out in second half of this calendar year. The US Federal Reserve has withdrew $625 billion in last 1 year, but post SVB bank crisis, it has pumped in again $370 billion of liquidity into the system. We believe that liquidity is likely to improve further in second half of this year, which should result in outperformance of equity going ahead. If you look at India, India will have one of the highest GDP growth in the world at around 6.5% versus the anemic growth we are looking at in US, Europe, and China is also having a lower growth compared to its recent past. This should result in relative attractiveness of India compared to global markets. At the same time, the strong GST collection and direct tax collection is helping Indian economy, which is at a very strong footing. The manufacturing activity in India is very, very robust. And currently, India is preferred sourcing base for MNCs. And hence, India's market share in terms of manufacturing export is going up very sharply. We will discuss this in detail in following slides. At the same time, the banking sector credit growth is 15%, which is very, very robust compared to last 4-5 year average. At the same time, as the economy is doing very well, the provisioning and the NPAs are also at lower end of the cycle. Automobile and realty sales, if you see, some of the numbers posted by Maruti, Mahindra & Mahindra, TVS are showing a strong auto sales on a monthly basis. At the same time, DLF, Oberoi are showing highest ever sales on a monthly basis. At the same time, the high pace of digitization is helping India to grow very rapidly on the digital side. India took almost 70 years to reach 6 million point of sale machines, while in just last 3 years, we have achieved 50 million QR code implementation. This shows the pace of growth in India's digital journey. We feel that India will have a strong corporate earning growth of around 15% over next 2 years. This is about Nifty 50 companies. This should augur well in terms of earning improving over next 2 years, and hence the valuations will also catch up. At the same time, we have seen there is a strong domestic inflows coming into equities. The SIP book has gone about 12,000 crore per month on a monthly basis now, from a major 5 to 6,000 crore 3-4 years back. Indian equity markets are currently trading at 3% premium to its long-term average. And at the same time, if you compare India's valuation in terms of emerging market, MSCI emerging market valuation, we are trading at 82% of valuation compared to 150% in September 2022, and the long-term average was around 59%. So independently, if you see the valuations, we are trading at 3% premium, and if you compare with MSCI emerging market index, that premium also has come down to 82% versus 150% in September 2022. Hence, we are seeing in the moderate growth scenario, along with the tightened liquidity, we cannot rule out some of the financial accidents which we have seen recently in SVB and Credit Suisse in the global markets. And hence, FY24 will be a year of accumulation and investment for the investors. Investors should treat any dip towards 17,300 to 16,800 Nifty level as a strong buying opportunity with a medium to long term view. So if you see a Bloomberg Commodity Index from June 2022, it has corrected almost 20%. So this shows that most of the commodities have come down, and that has resulted into lower inflation in US market and in India also. US inflation, which peaked at 9%, has come down to below 6% now. At the same time, this is resulting into lowering interest rate expectation in the US. So this is a historical chart of how Federal Reserve has acted on interest rates based on the crisis. The recent history of 2007 subprime crisis or the tech bubble in 2000, these are some of the examples of whenever there is a crisis happening, Federal Reserve reverses its stance on interest rates. We feel that current SVB crisis and Credit Suisse crisis should result in this kind of reversal in Federal Reserve stance on interest rates. This is already seen in the expectation of Federal Reserve rate cycle over next 2 to 3 years. From the peak of 5.1%, investors are expecting, this is a Morgan Stanley and Federal Reserve expectation of how the interest rates will move over next 3-year period and the long term. So here you can see the expectation is 2023 and 24, we will have interest rates from 4.3 to 3.3%. And the long-term average will go to 2.5. So this shows that the trajectory of interest rate rise is at the peak, and we will see a reversal going ahead. So apart from these global points, we are looking at why this decade belongs to India, which we discussed in our last time's presentation also. So if you see number of households which are earning 10,000 to 35,000 income in US dollar terms will explode to 165 million households compared to only 70 million households in 2021. This is in next 10 years. So the growing middle income household increasing to almost 46% of population will result into a stronger consumption in Indian economy. This is a very, very important chart. At the same time, we feel that India's GDP growth will surpass $7.5 trillion by 2031, and India's market cap will grow 11% per annum over the next 1 decade. The manufacturing share of GDP will rise to 21% by 2031, and export market share is likely to double to US dollar 1.2 trillion. At the same time, as we have seen in the earlier slide, the per capita income will rise to 5,250 US dollars in 2031 versus 2,300 right now. This will help boosting the consumption in Indian economy. At the same time, the credit to GDP will rise from 57% to almost 100%, implying a compounded annual growth in banking credit of 17% over the next 10 years. I would like to invite my colleague Rishikesh to take to the further slides. Thank you.
Thanks, Samir. Welcome, dear participants, for this webinar today. Uh, so, a lot of water has really flown under the bridge since last we met in January 2023. So, be it Adani Saga, which happened in Feb, be it the Silicon Valley Bank and the Credit Suisse, and also the rising interest rates, which looks like will not stop, but now scheduled to go down. Looks like. So a lot of things have happened. So just to focus on few things, and how do we really see 2024? Let's start again. GST collection was somewhere around. So we have been saying this GST collection for monthly basis. This is an annual collection that we are showing you here. So if we see here from 2021, 22, and 23, so the annual collection has been increasing at a very healthy pace. So be it in 22, which has gone up 30%, be it in FY23, which again it has gone up by 22%. So which shows the kind of collection, GST collection that we have for these years. Yeah. So the next this slide is on this capitalization. So considering what happened with Silicon Valley Bank and the Signature Bank, and of course the Credit Suisse Bank, Indian banks are very well capitalized. The balance sheets are really strong, and we see all the banks here. Most of the major banks are extremely well capitalized. RBI has done a phenomenal job in terms of handling this entire crisis and making sure that we don't have such kind of bust which the US had in recent past. This is again on credit growth, and we see that this is a quarterly credit growth. So from June 2020 onwards to recent March 24, 2023. So the credit growth has steadily increased. So we can see over last 1 year, it has been like 14, 15, 16, around that percentage. So that is really a good sign for us to ensure that the kind of growth which is there in the system, the healthy sign of Indian economy, is something which is reflected here. This is on the valuation front. So with the recent correction which has happened in Indian markets, thanks to the different reasons I just mentioned some time ago, we have had correction in the P. So the Nifty P is now more at a reasonable valuation, around 17.5 to 18 times on forward basis. So the average has been around 17 times. So we are quite close to what it has been on an average basis. Similarly, in price to book as well, we have more or less corrected from high of from 3.5 times, now to 2.83 times. The average has been 2.5 times. So we are just about near those valuations now. So this is a very interesting chart. This shows the kind of the premium India has over emerging markets. So what has happened essentially is we had a premium of around 150% over emerging markets, but now it has kind of gone down, especially in last 4 to 6 months, and that's a very good sign. So what has happened initially? What has happened here is basically post China reopening, the Chinese markets have really gone up. So that is one additional benefit for, let's say, our valuations to come down to the reasonable levels. Another thing which has happened is the Europe's relief has really improved in terms of the gas prices which had gone up, the energy prices. So that has really kind of bumped up in terms of Europe also going up along with the Chinese market. So that has helped in a way, and our markets are more or less stable, a little down. So from that perspective, what has happened is our premium has gone down from 150 odd percent to now around 80 to 83%. So which is a reasonable kind of valuation that we have for all these years. If we see it was around 60%, we are near about that. Not exactly, but to some extent, the kind of things that we had seen in the past. So this is again a very important chart, and I would like to mention here, stress about certain points. So one of the point is on the FI and DI. So these are the different investors that are presented. So we see from 13 to 22 calendar year, The kind of FI flow was around $70 billion, and we have gone up to now $77 billion. So it was not that much, before 18. So after 18, 19, after the COVID times, the flow of DIs, domestic institutional investors, have really gone up to a lot of times. So from 4 times from calendar year 18 to 22, and around 4.5 times from calendar year 20 to 22. So that is where we have kind of the domestic institutions, the SIPs, the mutual funds. All of them have really done well in terms of making sure that we are really on the steady and growth path from the equity markets perspective as well. So now we would like to throw some light on different sectors that we really are bullish on for next quite some time. So first of all, it's a manufacturing, and that is because the manufacturing as a percentage of GDP right now is just 15%. And Indian government has a very they have really kind of said that we need to take it up from 15 to 25%. That will take some time. Maybe it will take 7, 8, 10 years, but that's the objective that the government has. Plus China and Europe plus one also is playing in that role in that way here. A lot of capex revival is happening, consolidation is happening. Maybe the exports, the export as a percentage now is really low, and Indian government really wants to focus that export should really go up. Indigenization is happening in a big way. So be it in defense, where government has a clear focus on the manufacture in India, plus the different PLI schemes and the energy transition, which the government is really undertaking. So from let's say coal-based, we are getting into the clean energy, and that is going to be playing major role in terms of manufacturing. BFSI, we are always bullish on, and that will continue to be there because of the limited capex, which has capacity utilization, which has happened in the past. The balance sheets are better, and so for both the lenders and borrowers, and so is the retail growth, which is really, really good in a way. So apart from that, consumption also looks good because of course, with all these things happening, the India's booming class and so on and so forth, the consumption will definitely pick up. Another sector that we are really bullish on is pharma now because of the reasonable valuations. Correction, a lot of pain it has gone through for last 2 to 3 years. The supply chains are getting better, which is leading to the reduced input prices. And of course, the pricing pressure in US is also receding. So all these put together, these are few sectors that we are really bullish on. So a couple of stocks that we would like to mention. One, of course, is Apollo Hospital here. So Apollo Hospital is again into the hospital chain that we all know, but they are also into pharmacies, primary care, the diagnostic centers, and all on top of it, they are also in this digital healthcare services. So when I say digital healthcare, they are into having these digitally enabled platform for especially the healthcare services that they offer. So that is going a big way. Will continue to grow from this as well. And Apollo Hospital is one of the leaders in terms of the businesses, hospital business, and that's where things look much better for the bigger companies, the bigger hospitals, vis-a-vis the unorganized segment. So Apollo Hospital will stand to gain a lot in coming years, be it from the Indian and also from the foreign tourists, medical tourists. So that is another good point. To come to the diagnostics again is really increasing, and that is where things are improving for them. So all these things, e-pharmacy also is one of the major things which they are really improving on. So apart from Apollo Hospitals, we'd like to mention ABB India. So I just mentioned about manufacturing as a sector and why really we are bullish on. So ABB India stands to benefit. It's one of the biggest manufacturing companies, and the products and the services that they offer are more towards very unique in a way, and very limited scope for someone to enter and be a part of ABB or to be like ABB. So from that perspective, it always has got the scarcity premium, as the valuations will remain high. But in short, things will look better and better for such companies going ahead as well. So be it in electrification, be it in the data centers, warehouse and logistics, railways and metros. So all these areas are complete focus of government, and hence ABB stands to benefit a lot over a period of time. And we really request investors to invest in both these companies now even at these levels and whatever depths which when the market happens. So that's the suggestion. Now I would like to welcome Sonal for the technical analysis. Thanks.
So, what we are expecting is that the Bank Nifty had outperformed on the way below, and same we are expecting going ahead. So, Bank Nifty brilliantly led the index. First, it absorbed the buying pressure, as the selling pressure, sorry, and then eventually caught up well, and has now this week itself broken out of a very tight range. And this level is not a small level. It has a good amount of significance attached to it, 41,800 level. And what we expect going ahead is that Bank Nifty has the qualities and the strength to pull the Nifty also to good levels on the higher side. So we are banking more on the banking index and Nifty. Bank Nifty minimum the resistance level is the all-time highs which it had staged last year, and we expect it to sooner or later test it, if not break it. And Nifty also should soon follow suit, except the IT index, majorly because of the results they are struggling. But then the banks have the setup very much intact, and they have the strength to pull Nifty at least to 18,300 levels. In any case, the dips were being bought into, and 17,300 is the immediate strong support below 17,800. And we expect we should be having a buy on dips approach, if not if you don't want to participate on the higher side aggressively. But Bank Nifty seems to be the one which can lead the markets to good highs. That's it from my end. Thank you.
I would also like to add that while IT could underperform in the coming quarter because of also the tepid results of Infosys, uh, FIs have understood that Indian banks are in a much stronger position than banks in most other countries, uh, unlike US and Europe, and that will lead to some money getting out of IT and coming into banks. So I think banks could outperform most other sectors of the coming quarter. Thank you.
A warm good morning to all our esteemed guests. I'll be taking you all through the mutual fund sections and spend around 5 to 6 minutes. For the April 2023 edition, we would like to introduce to a new concept which we believe it's going to be a need in the portfolio going forward after the new tax rule has come into effect in the debt fund, which says return from any category of debt funds investments made after 1st April would be attract tax and would be taxed as per the income tax slab rate, which could make debt funds less attractive. I'm sure most of must have heard about this category called Balanced Advantage Fund. Let us understand what is this Balanced Advantage Fund and its tax liability. The investments made into Balanced Advantage Fund get invested into two asset class, namely equity and debt, and are managed more dynamically with certain predefined parameters, which makes it very attractive. Because for asset allocations amongst equity and debt, it does not take into account any personal opinions and views on market of the person managing the fund. Importantly, equity rebalancing happens on a daily basis in this balanced advantage fund category. Since it's 35% of the holding will always be in equity, it enjoys the equity taxations. Now let us look at the illustration. See how it is more benefited through dynamically managed. Refer to the row highlighted in green. In the year 2013, the equity allocation went as high as 77%. And in that year, we had a taper tantrum. Back then, the US yield spiked from 160 to almost 3%. Now you refer on your right, highlighted in red, back in 2018, when the valuations of the market went very high, the equity allocation came at low of 30%. Similarly, during the COVID times, also the equity went to a high of almost 74%. In all these 13 years the average equity levels were almost 50%, went up to a high of 30, went to a low of 30 and went up to a high of almost 74, which has resulted into the return of little over 11% compounded return over these 13 years. On the fixed income side, given the current high inflationary environment across the world, the interest rates have picked up globally, and India, we are almost close to the peak. Generally, interest rate cycles are one-time cycle of topping and bottoming in 3 to 5 years time frame. Having said, we strongly recommend our investor considering the fixed income at this point of time. In fixed income, we suggest considering company FDs like Bajaj Finance, HDFC Limited, and also for a matter bank FD with combination of RBI bond with a floating rate may be a good idea to consider. And all these FDs gives you a option of interest payout either quarterly, half yearly, or yearly. Beside that, those who are on a very high tax bracket, tax-free bonds could also be a good category to look at. In fact, the tax-free could be a better options even compared to FDs for everyone since you are locking the yield at a higher rate. This brings to our end of our presentation. Hope it was a good insight and you all enjoyed listening to us. Now we will open for question and answer session. I would request our audience to raise their hand to ask question or put their questions in the chat box. Thank you.
Thank you, dear participants. The first question is about the new tax regime, which has come in the last 4-5 days of March. So I would like Ajay to give his view on the new tax proposal which the government has come up with and the impact of it on the debt investments. Thank you.
Good morning, everyone. So earlier for HNIs, mutual funds was a great way to invest in fixed income because unlike an FD where you are taxed at 35%, because of the indexation benefit, your tax rate was effectively 4 to 5%. So if you got a pre-tax return of 7.2%, that resulted in a post-tax return of almost 7%. But in the budget, the government has decided that these benefits that mutual funds had over bank FDs was giving an unfair advantage to mutual funds over bank FDs, and they are now taxed at your tax slab. So if you're at 35% tax slab, you have to pay 35% tax. If you're at 20% tax slab, you have to pay 20%. And it's been very unfortunate for us. And now also we'll have to look at options other than just these pure debt funds. And there both FDs, like Nirupa mentioned, Bajaj Finance, HDFC, score well. But historically, even the balanced advantage funds have done very well because they have tried to take advantage of the swings in the market, and when the markets are on the higher side, they reduce equity and go to debt. Like just before COVID, good funds like ICICI Balanced Advantage Fund had reduced their equity exposure to as much as 35-40%. But when COVID happened and market came down, they took the exposure up from 35 to almost 75%. So because this periodic rebalancing and because they are not pure equity but a mix of equity and debt, the swings on the market have not led to very high swings in the NAV of the mutual fund, of the balanced advantage mutual funds. So the ride has been much smoother and the returns have been at 11%, which is not very far from equity mutual funds. So the equity mutual funds over the last 10 years have been around 12 to 13%. The balanced advantage funds have been at 11% like ICICI, despite taking a significantly lower risk and giving you a tax return. So our belief is a large amount of money that we were putting in debt mutual funds could move to balanced advantage funds or a mix of balanced advantage funds and FDs, which are right now giving close to 8%. Thank you.
Yes, sir. The next question is on the mutual fund side. What should be the investment options in the debt fund funds and especially liquid funds. So I would like to invite Nirbam to address this question.
Amit, can you repeat? It's for the existing investments or new investments?
Existing investment in debt funds and
Yeah.
liquid funds.
Yeah. So there we believe that this should be the last to be exited because you are still be eligible for the indexation benefit because your investments were done before 1st April 2023. So there we won't have any tax implications. As far as the yields are concerned, we are sure the yields, the investments must have come in last 1.5 years where the yields were on the rising side. So we believe that we should stay invested and enjoy the tax benefit of indexation.
Basically, Nirupam is saying is for our old investments, we still enjoy the benefit of indexation. It is only our new investments which will get affected.
Thank you, Ajay and Nirbam. The next question is on the sectors which Ajay is positive on with 5 to 7 year view. So investor is looking at very long term view of 5 to 7 years, and which are the sectors we are banking on.
We believe that with this government's very strong focus on manufacturing, manufacturing will do very well because in the global space, we had earlier lost that space to China, but this government has decided to make it a very important focus. And within manufacturing, again, we believe that railways and defense could do better than other sectors. Even in this budget, the biggest increase in allocation was to railways, if I'm not wrong, almost a 60% increase in allocation. And again, globally, after the Russian-Ukraine war, most governments have realized that they need to increase allocation to defense. And in India, the government has decided that they want to give Make in India within the defense space a very strong thrust. So manufacturing would be one very important area. And I believe that also banking in India will do very well because credit growth will remain in that band of 13 to 15%. And while PSU banks might do well for a year and a half, I believe the private sector banks will continue to do very well over the next 5 years because private sector banks will have only a 35% market share in the total banking sector. And they will keep taking market share from PSU banks and give returns of between 15 to 20% over the next 5 years. So banks like ICICI Bank, HDFC Bank, and good NBFCs like Bajaj Finance should give very strong returns over the next 5 years. Thank you.
Thank you, Ajay sir. The next question is about cement sector. So I would just like to take this question on cement. So looking at the stronger road development which is happening under Gadkari, Minister Gadkari, we are looking at very strong revival in road construction activity across India and especially on the eastern side of the country. And that's why we feel that cement should have a very strong volume growth over the next 3 to 4 years. And we are quite positive on the volume growth side in cement. The only challenge is with Adani coming into cement sector now, the pricing should be stabilized, and we feel that the profitability will also be quite positive for this sector. So that way, we are quite positive on cement sector with 2 to 3 year perspective. Next question is for Rishikesh. Your views on IT sector with Infosys and TCS posting weak results.
Yeah, thanks, Amir. IT, yes. So especially these TCS and Infosys results have not been so good. And one important thing which has come out is in terms of banking being like 40%, 35 to 40% of the big IT companies like Infosys and TCS. And that's where the pain is in US especially. So the commentary as such is not so good. And looks like another 3 to 6 months also things might not be good. So we are not so bullish on the IT segment but of course, in terms of correction, whenever it happens, time correction and price correction, and the valuations, if we're getting a little cheaper than the current ones, then definitely IT should do well after from that point in time. So I think investors should look at IT, but in dips and in stages, because long term, yes, things may look good. But of course, in short term, of course, things are not so good. So take some time, invest is what I would suggest in IT. And especially, I think we should consider the companies which are good in terms of growth and the execution. So in the likes of Persistent is one of the companies that we would like to have your thoughts on. That's something that we are really bullish on. Should be looked at dips, and definitely it's a good buy for a long term. Thanks.
Thank you, Rishesh. The next question is for Nirupam. When the balance advantage funds raise debt portion greater than 35%, won't it result in higher taxes as indexation is absent? Nirupam, can you share your views on this?
Yes, on a particular day or a particular fortnight or a particular month, the equity or a debt allocation can go below that range. But what the regulator says, it should be the average of the entire year. So because of that, it won't get into that, this thing.
Thank you, Nirupam. The next question is on gold. Ajay sir, can you share your view on gold with next 1 to 3 year perspective? That's what the investor is asking.
Our belief is that gold could give returns of 8 to 10% over the next 3 years, because gold does well in a period of global uncertainty and in periods of high inflation. And we believe both these factors remain. And so gold could be maybe between 8 to 10% over the next 3 to 5 years. So higher than FD returns, but lower than equity.
The next question is about chemical sector. So I would like to address this question on chemical sector and which of the companies you're looking in that segment. So chemical sector, which has seen a very high P before, if you see last 2 years back, chemical companies were trading at very high valuation multiple compared to their historical average. But in last 2 years, post this China supply chain issues and COVID related issues, and with margins coming down, the chemical sector valuations have corrected quite a lot. So in this segment, we prefer companies like SRF and Navin Fluorine, which are into high complex molecule manufacturing, and where the complexity of molecule is very high, resulting into higher margins and higher ROC for the companies. So chemical sector can be definitely looked at, and entry points we can definitely discuss in detail with the investor on one-on-one basis. But we can definitely look at some of the stronger companies, high ROC, high margin companies like SRF and Navin in this space. The next question is about Russia-Ukraine crisis and your views on China again supporting Russia in this segment. So I would like to ask sir to take this question on Russia-Ukraine crisis and China entering into it. Thank you.
So the Russia-Ukraine crisis is a thing of the past, and when it first happened, global commodity prices had gone up very sharply. Prices of gas in Europe had gone up very sharply. But now the market has factored in that this is going to continue forever, at least in the near future for next 3 to 5 years. And both commodity prices, which had gone up sharply, have come down to below the time when the war occurred. And even gas prices, which had gone up very sharply and had created a huge shock for companies in Europe, they too have come down to below where they were before the crisis. So now it's a thing of the past, and the markets have completely factored in. And China supporting Russia, we don't think will have any major impact on equity markets globally. So now the markets will get affected if we have some new crisis, but this crisis has already been factored in.
Thank you, Ajay sir. The next question is about the risk you are anticipating from globally and Indian market. So as we highlighted in the initial slides, that some of the negatives which are there in global markets are like this banking crisis, which is going on in US and Europe. But we feel that central banks post Lehman Brothers crisis have really been very active in terms of acting on any of the bad news in the banking sector. And this time also, we have seen Janet Yellen saying that they will give a blanket support to all the depositors in the US. So this shows the intent of governments and central banks in terms of taking action immediately on any crisis in the banking sector in the US. At the same time, we feel that US recession is highly talked about, and historically it is shown that actual recession doesn't happen whenever everybody is talking about it. And actually, we are looking at stagflation rather than inflation, rather than a deep recession in the US. That's why we feel that maybe it will be a 3 to 4 month kind of stagflation rather than a deep recession in the US. Apart from that, the risk may look at like next year we have a general election in India in May 2024, and US will have an election in December 2024. But we feel that historically we have seen pre-election rally in most of the global markets, and this time will not be a different compared to that. The next question is about Bajaj Finance. So investor is asking Ajay view on Bajaj Finance with a 3 to 5 year perspective, and why it is underperforming in last few months.
So with Bajaj Finance, a lot of investors have a question of why it has underperformed this year. While profits had gone up from 7,200 crores last year to around 11,000 crore plus this year, the stock has underperformed because there was a big shift globally from growth-oriented stocks to value-oriented stocks. So even in India, stocks with very high growth, like Bajaj Finance or DMart, companies which are going at more than 40% and which had a very high multiple, they had a very bad year this year. And companies which come in the value style, let's say HTPC or a Coal India or some PSU banks, Power Grid, companies which generally have a multiple of under 10, they did very well globally this year. It was also because interest rates in the US went up. So when interest rates go up, they affect growth companies. Historically in India, out of every 10 years, growth companies have done well for 6.5 to 7 years, and value companies have done well for 3.5 years. So we had growth companies doing very well between 2013-14 to almost 2019-20. And then last 18 months, companies which have a value style have done well. So we believe value style might do well for another 6 months, but then growth would come back because India is considered a growth market, and generally globally FIs have bought India for growth. For Bajaj Finance, our profit estimates are that while this year would end at 11,500 crores, the coming year the profit would be 15,500 crores and 21,500 crores in the year after that. So we see profit almost again doubling over the next 2 years. And we believe that Bajaj Finance should do quite well in the second half of this year and again next year. So after 10 years of consistently outperforming markets every year, this is the first time that Bajaj Finance has underperformed the index. And we believe that this should reverse in the coming 2 years. Thank you. And of course, profit growth will be very strong. Like I said, profit growth would be would move from around 11,000 to 11,500 this year to around 21,500 in the next 2 years. And the other thing is that the multiple has come down from around 40 times forward to around 23 times forward. So the valuation that Bajaj Finance used to also get has shrunk drastically from 40 times to 20 times. So this valuation sets it up for good appreciation on the coming 2 years. Thank you.
Thank you, Ajay sir, for the detailed answer. The next question is for Nirupam. On the equity investment side, how should investors deploy their funds? Whether they should adopt a STP approach or they should do a lump sum investment?
So I believe that we should always look investing into equity through STP route, like system transfer plan, from now to next say 3 to 6 months, and in between if there's any correction because of some external global factors or some domestic factors, then one can always upfront those investments. But you should start with a system transfer plan for next 3 to 6 months with the option of prepone the investments or the transfer if the market corrects.
Thank you, Nirupam. Next question is for Rishikesh. The investor is asking about why he feels Apollo Hospital should be the company which can be looked at, because looking at the deal which has happened in one of the second biggest company in the hospitality space, the investor is asking how it will imply FII flow into companies like Apollo Hospital.
Yeah, thanks, Samir. So Apollo Hospital. So when we are recommending Apollo Hospital, we are recommending basis the credentials of own Apollo Hospital. So Apollo Hospital is, of course, other companies, other hospitals, companies are especially into hospital business, but this company caters to all lot of things related to healthcare and medical services. So it's just not a hospital chain, but it also is into a lot of other things which are really growing at a very healthy pace and will continue to grow at least in near future. Now, Apollo Hospital also has corrected from the highs of like 5,000, 4,900, 5,000 to as low as now 4,200, 300, in that range. Now it is 4,400, but it was recently at 4,250, that area. So it might come down to that area again. So that is a possibility that we really cannot rule out. But I think from that perspective, the valuations are also attractive from a forward basis. And hence, we really are gung-ho about this company and also considering the execution which Apollo Hospital has done over last all these years, and especially in last 3-4 years also, the company has done very good in terms of getting the debt down. Debt to equity ratio, you can see, which was like 1:1 in 2018, is now close to 0. So the return on capital employed for the Apollo Hospital also has increased. So all these parameters shows that the management is really concentrating and focusing on one single parameter, which is getting the financial act together, which it has already demonstrated and will continue to do so in future. Yeah, thanks, Samir. I think that's what I would like to address about it.
Thank you, Rishikesh. The next question is about considering fear of US recession and 2024 election in US. Is it better to reduce equity exposure at current level? I would like to request Ajay sir to address this question.
In our opinion, if there is a mild recession in the US, interest rates will come down. And the stock market actually is more linked to interest rates than a recession. So when interest rates go up, the stock market comes down, and when interest rates come down, the stock market goes up. So the correction in the Nasdaq also happened while those companies were already doing quite well. It happened almost 3 to 4 quarters before the earnings of the tech companies slowed down. So while the earnings of Google, Amazon, Facebook, Microsoft were hitting new highs, the stock market had already corrected 20% because interest rates had started to go up. So we believe that, and historically, the US market has done well in years prior to elections. So our view is that we shouldn't reduce exposure in equities at this stage. Also because valuations also are reasonable now. So we have had an 18-month time correction and multiples have corrected from almost 21 times forward to 17. So this would not be a time to reduce equity exposure.
One more question is on a mutual fund side, on the asset allocation side. So Nirupam, can you address the question on how the investors should look at asset allocation as an instrument, as a tool for investing with a 3 to 5 year or longer term perspective? The importance of asset allocation.
Yeah. Generally, we are on the opinion that the asset allocation plays a vital role in framing the portfolio for a long term. And what has worked out well, even from the illustration which we have shown on the balance advantage fund, that if you maintain the asset allocation dynamically, if you could do it in a wise manner, then probably you can also outperform the market. So there, if you have observed the illustration, the return on equity was almost close to 10% over last 13 years. But at the same time, with this asset allocation perspective, the return was almost close to little over 11%. This itself reflects how important the asset allocation is. And generally, the thumb rule, what we have been, using for our clients is that should have at least say one third. Anyways, most of our investors have exposure through real estate. So beside real estate, at least one third of the portfolio should be in debt, and the remaining one third or two thirds should be in equity, which could give you a better perspective. And the portfolio could also grow at almost double digit return over long term. And also, what important asset allocation plays is when the market corrects. So the time when last 1 year return has been flat, if you had some allocation into debt funds or fixed income, you have option of switching those investments to equity at this point of time. So this gives you a option of playing around equity and debt at the same time.
Thank you, Nirupam, for the detailed answer. As there are no further questions, I would like to thank all the investors for participating on this KSL 2024 Outlook webinar on a Saturday morning. Thank you, dear investors, for your precious time, and looking forward for many more webinars going ahead. Thank you. Have a great day. Thank you.